gave a speech last week that I think was largely overlooked. It was very pessimistic. He suggested that some of the imbalances in the economy, like the big trade deficit, the low savings rate, and low interest rates, may end up disrupting growth, and that's different from what Chairman Greenspan has been saying. He says these things work out in a gentle way, that the economy survives. Joining us now is someone who agrees with Governor Cohn, and a guy who we've been saying, Mark, makes Stephen Roach look like an optimist. Peter Schiff, president of Euro-Pacific Capital. Morning, Peter. Let's talk about this split, or this debate between inflation and weaker growth. You think we get both?
I think we do. I think we've had a lot of inflation over the past several years. It just hasn't necessarily been reflected yet in the CPI index, but it's reflected in the value of the dollar. It's reflected in commodity prices. You know, people feel it at the gas pump, that they feel it at checkout counters, but I think it's going to be more and more evident as the years progress.
So what does the Fed do? If you have rising inflation and ostensibly slower growth, you can really only fight one of those things at a time, can't you?
Exactly. But the Fed really can't do anything. The problem is, for the past few years, the Fed has pursued a policy meant to delay the resolution of these imbalances. But in so doing, they've exacerbated those imbalances, and they've assured us that their correction is going to be a lot more painful.
Some people look at the trade imbalance and say, well, wait a second. That's foreigners sending us their money. They're investing in the United States. We're buying their stuff. That's a sign of good economic growth.
Nice.
Why should we not see the trade imbalance as a big... I mean, people like you have been predicting doom and apocalypse and Armageddon from the trade imbalance year after year after year. It doesn't happen.
Well, I think, first of all, by taking an investment approach that we have for the last 5 or 6 years, we've certainly done a lot better than having left our money here in the dollar. But the problem is, foreigners are exchanging real goods that they produce in exchange for our IOUs. And so they're giving us products that it takes scarce land, labor, and capital to produce, in exchange for which we give them little pieces of paper that we produce basically at no effort. Now, since we don't supply the world with any exportable goods to spend with those dollars, their central banks are accumulating them. And so, you know, it's not really doing them any good. I mean, people keep looking at the United States as if we're the engine of the global economy, when in reality, we're the caboose. All we're doing is consuming what everybody else produces. And if America stopped consuming, and one day we will, because the dollar will fall so dramatically that we can no longer afford to consume, that's when the rest of the world will begin to live a much higher standard of living, as they now can consume all the products that previously were consumed by Americans.
Well, I beg your pardon, but won't they be broke because the value of the dollar holdings will have declined?
The value of their dollar holdings will have declined, but the value of their non-dollar holdings, of which they have in far more abundance, will have gone up dramatically. So, like, perfect example, Americans right now consume something like 50% of the world's gasoline. Now, when the dollar collapses, all of a sudden gasoline is going to become very inexpensive for everybody outside the United States. They're going to consume a lot of it. Americans, on the other hand, are going to have to consume a lot less of it, because the dollar is going to be that much lower. I mean, that's the real reason that oil prices have been rising.
The dollar is going to collapse.
It is going to collapse.
What's it going to? If the euro's $1.29 now, what's a collapse?
Well, I mean, first of all, if you look at what former Fed Chairman Paul Volcker said, he's quoted as saying he thinks there's an 80% probability that the dollar will collapse in the next 5 years. So it's not, you know, just me saying this. But I think if you look at, let's say, the dollar index, which is right now hovering around 83, I think once it breaks through the long-term support at about 80, which goes back to the early 1990s, I think it's going to get halved at a minimum, which would put the dollar index down at about 40. But I think the currencies that are going to do the best against the dollar are not going to be the European currencies, the euro that everybody talks about. They're going to be the Asian currencies. Those are the countries that are producing all the
Peter,
goods.
they're right now, they're linked to the dollar right now.
They are now.
They de-link as we fall?
Of course. I mean, that's why, I mean, one of the biggest investments that we've been making for our clients have been in Chinese-based assets that are low PE, high dividend paying, but earn their revenues in renminbi. Because once the Chinese abandon this ridiculous currency peg and allow these currencies to appreciate, you automatically get a huge gain in your assets.
Peter, we ought to go there, because whether or not this horrible story comes true, you have been able to make some money for clients by having this overseas outlook in your portfolio.
Putting it mildly.
But talk about it.
Well, I mean, basically, I mean, if you look at what's happened in the last 6 years.
Swagger there, Peter.
Well,
yeah, go ahead.
Well, I mean, in the last 6 years, right, the U.S. stock market has basically gone nowhere. The S&P, the Dow, the NASDAQ. Meanwhile, the dollar's lost about 30% of its value.
Right.
I mean, all you had to do during that period of time was buy foreign certificates of deposit. and you had double-digit returns.
Well, there you go. So you're not so smart after all.
Well, but here's what we did. I didn't buy CDs.
I'm kidding, by the way.
What we bought for clients were low multiple, high dividend paying foreign assets. Generally, the dividend yields that we've been collecting have been 8 to 10%. In some cases, we've been buying a lot of energy trusts for the last 4 or 5 years. In many cases, have been paying 15 to 20% a year. But also, the underlying appreciation in those assets, as the value of the raw materials that they own has increased, or if they're foreign, you know, the currency gains. And a lot of the stocks that we bought around the world have also shown some marginal gains in terms of their local currencies. So having to get a 20 or 30% return in that environment every year, not taking a lot of risk, has not been that difficult to maintain.
You get appointed head of some government agency today. What do you do to head off the coming disaster?
You can head it off. I mean, that's the problem. Some disasters have to happen. The problem was
we just ought to give it up right now.
Look, the mistake
we can do.
You can't head it off.
Well, look, the mistakes were made.
Reasonable or logical.
If you're drunk, if you want to get sober, you know, or if you're high on drugs, you got to go through withdrawal. The mistakes were made in the 1990s. I mean, you guys were here during the late 1990s. You know about those mistakes. You reported on them. There were tremendous amounts of malinvestments made during that period of time. People invested tremendous amounts of money in these cockamamie, harebrained internet companies and telecom companies, and we have yet to have the recession that we needed to have to purge the economy of those excesses.
What are you talking about? We had a severe recession.
We're severe
in
recession.
the tech sector.
But we didn't have a recession in the overall economy because of the Federal Reserve.
The overall economy didn't have the bubble that you're talking about. The bubble was in the tech sector and in telecom. And
right, but then
the
Alan
correction
Greenspan
came.
blew up another one so the consumers can spend to keep us out of a recession. You don't have a recession with record high car sales, with record high home sales. You don't have a recession where consumers end the recession with more debt than when
Peter,
they began.
we should add that one of the things that Cohn said on Friday, Governor Cohn from the Fed, he said that the Fed ought to raise interest rates regardless of the impact on housing prices, which means to me that the Fed is ready to give some of that medicine to the economy.
Yeah, and look, first of all, this quarter-point increase, I've been talking about the fact that the Fed wants to get to neutral. Inflation is rising a lot faster than these quarter-point increases. So the longer they drag their feet on raising interest rates, the higher they're going to have to go, because real interest rates are going down. Nominal rates might be going up, but the real interest rate on U.S. dollars is going down. The Fed is so far behind.
If I could just come back to China for 1 second, because so much of what we're talking about here seems to come back to that. I mean, we consume an awful lot of stuff from China.
That's right.
But it would seem to me that ultimately, if they delink their currency to ours, and if the dollar continues to plummet, they're not going to be able to sell nearly as much stuff to us. I mean,
they're going to sell it to themselves. See, as we get poor, they get richer. It's the other side of the seesaw.
They got 1 billion people right now, and only 100 million are in their middle class. But they still have enormous amounts of costs in their own country to deal with.
As the dollar loses purchasing power against the renminbi gains purchasing power against the dollar. So that by definition, the Chinese become wealthier under that scenario. They can now afford to consume their own products.
Right now, they're taking it on the chin. This decline in the dollar means that their prices, because they're linked to the dollar, David, means their price for oil have also gone up.
Yeah,
if they were to delink, and it is a debatable proposition, Peter, if the yuan were to appreciate relative to the dollar, then their cost for oil would go down.
Their cost for everything will go down. And you know, right now, what they do is they have these factories, and they put products on ships, and they send them out to California. And you can see the ships. When I was down at Newport Beach, they go all the way down to Huntington Beach, and they leave empty. They would be much better off, instead of sending all the products that they produce to America in exchange for nothing, to consume those products themselves and get the enjoyment out of those products that Americans are now getting.
All right,
they have the beginnings of a consumer economy there. There's no doubt about it. I mean, in China, you know, there are quite a few washing machines and dishwashers and everything else in many, many homes, certainly in Europe.
Well, there's going to be a lot more when they let the dollar collapse.
But we're not going to benefit from that.
Of course not. We're benefiting from the artificial prop right now.
Well, they might have a lot of computers. Microsoft might sell them a lot of software.
Not going to be enough.
All right, I'm puzzled. Do I shoot myself or do I shoot him?
Don't shoot the messenger. You never heard that expression?
Peter Schiff, president of Euro Pacific Capital.